Hello, everyone. This is Dr. Carl Gabrini from Dalton State College. I work in the Wright School of Business. I'm an assistant professor teaching accounting. I've been here for, oh goodness, I guess 6 years now. And I've been teaching for the past, 13 years. And before that, I was an auditor, worked in accounting, spent some time as a controller. So I've been around accounting for quite some time. So the purpose of this is it's kind of a first video in a series I want to put together to basically review the kind of the nuts and bolts of accounting. I think if you get an understanding of how accounting works, what it's supposed to do, I think it gives you some tools to better read financial statements. So that when you're pulling open a set of financial statements and you're reading the line items in the financial statements or the individual financial statements themselves, you'll kind of have a better understanding of, what the statement is about, how it was put together, and where did it come from? It didn't come from thin air. Somebody didn't invent it. Uh, there is a set of rules that were followed in preparing them. Again, we can debate about those rules, but for purposes of this introduction, I don't think that's really necessary or warranted. I think at this point, we just need to understand that there are a set of rules that are followed. And so I think it just makes everybody a better consumer of financial information if they have this kind of grounding. And so we're going to go through first kind of an introduction to financial accounting. And then this will be followed with additional videos that I'll post online where we'll go through each of the financial statements individually, talk about each one of them, and then we'll probably do a little review of the accounting cycle itself and how it works, showing you how the transactions, the economic events that we identify as accounting transactions actually end up in our system and a part of the financial statements. So we'll do that. And then probably we'll end this with a video where we'll talk a little bit about financial statement analysis, some of the ways that you can kind of break down financial statements and both evaluate an individual firm and also be able to compare it to other firms that are similar in nature. Okay, so let's go ahead and get started here. So first of all, in terms of what is the general role of accountants, traditionally and still to a large extent today, we break it down into four different things. We need to identify the transactions that are going to be recorded in the system. And again, in order to be able to record an item in the system, a transaction in the system, what we do is we ask ourselves this question: is it affecting what we call one of the elements in the accounting model? And so this would be things like our assets, our liabilities, our equity, our revenues, our expenses, gains, losses, contributions by owners, distributions to owners, comprehensive income. These are kind of the general elements of accounting. And so what we ask ourselves is the transaction that we're looking at affecting one or more of those? And if the answer is yes, that there is a direct effect on one of those, then it's likely to be recorded in the system. An example of something that wouldn't be recorded in the system, although it's an important event, would be, say, the change in leadership. One CEO decides to step down or retire, and another CEO is appointed. No one can argue that that is not a major event in a corporation's history. It will very definitely have an impact on the organization, and it will likely have an impact on the organization's performance. However, it's not affecting directly any of the elements of financial accounting per se, and so we don't record that in the accounting record. But if we were to acquire a new piece of machinery, well, that does affect us. It affects a capital asset account, a fixed asset account, machinery. And so we would record that. So, and when we record it, we record it into what we call the journal. And the journal is just a chronological listing. That's all it is, a chronological listing of all of the transactions that occur in date order from, say, January 1st all the way to December 31st. Every entry for that particular year gets recorded in the journal. And there are some special journals that we will talk about at some point. We'll We briefly mention that they exist here, but we're not going to talk about their role quite yet. So we record. Then we classify and organize. And we do this by taking the entries out of the journal and then putting them into what we call the ledger. And the ledger is just a book of all the accounts that exist within that company. And so we take those journal entries and then we break them up and we classify them and post them to the ledger. And again, we've got the general ledger and then we've got subsidiary ledgers. And we'll talk a little bit more about what the difference is between the general ledger and the subsidiary ledgers. But for now, just know that they do exist. The general ledger is primary, the subsidiary ledgers are secondary. And then finally, after we do that, once everything's been classified and organized, we can then go ahead and we can generate reports. Okay, and so we generate a set of financial statements. So that's kind of how this process works. We have two different primary types of accounting systems that exist in the world today. There's something called accrual accounting, and there's something called cash accounting or cash basis. So the accrual basis is one where we look at things, instead of looking at things in terms of when cash has changed hands, we look at it based on a set of rules that say when transactions have actually occurred. So it's more of a timing issue than it is the exchange of cash. Whereas cash accounting, we only look at transactions based on, did cash change hands? If cash changed hands, then we would record something. Accrual accounting, cash does not need to have changed hands for us to record something. An example would be recording accounts receivable. Cash doesn't change hands when we record accounts receivable. So we can sell something to somebody without having cash change hands. And without cash changing hands, we would then record a receivable, and we would actually record that in the accounting system. That's part of accrual accounting. Accounting works based on sets of rules. And we just mentioned that some of the rules that exist, but they're different. Okay, so here in the United States, we follow generally accepted accounting principles that are created by a group called the Financial Accounting Standards Board, or FASB. They differ slightly, although they are converging more and more over time, with the International Accounting Standards Board, which provides international generally accepted accounting principles. And so a large portion of the world follows the IASB standards. The United States still follows the FASB standards, although our exchanges are accepting financial reports that are prepared according to international GAAP. And so those are two separate rule systems. And those rules are set up based on, it's not a bunch of accountants sitting around creating the rules. It's a bunch of people involved in business in various aspects. It's academics, practitioners, leaders in business, and they all have an opportunity to kind of have input into the rulemaking process. And so it is a very political process, but it does seem to work okay. Some would argue that some of the rules are not great. That's for another video, another time. But we just need to understand that accounting is based on rules. Those rules are dependent largely on where you live in the world. And so we have two different sets. We have the American standards, which are the FASB standards, and we have the rest of the world, which is IASB, or international standards. There is a process that we follow. And so this typically repeats itself over and over and over again. It's like a record. It just keeps playing over and over and over again. So again, first we record something in the journal. Again, we can have general and specialized journals. Then it gets posted in a ledger. So we can have general and subsidiary ledgers. Then we review it by creating a trial balance, which is just a report listing all of the accounts and their associated balances. Then based on our evaluation of that trial balance, we prepare adjustments. Now this is assuming we're doing the accrual accounting system, which is what most businesses, large businesses do. We use accrual accounting, and so this would include making our accrual adjustments, deferral adjustments, and any other estimates in the accounting system. And there are a lot of estimates in the accounting system. Then we review that adjusted trial balance. So we rerun the trial balance. We call it the adjusted trial balance. And we look at, again, the list of all the accounts with the adjusted balances. Then from there, we can go ahead and prepare our financial statements, of which I will go over who they are, what they are. And then once we've prepared our financial statements, we're going to close the temporary accounts. And the temporary accounts are the income statement accounts. And we close those income statement accounts to the balance sheet through retained earnings. And then we review a post-closing trial balance. So we run a trial balance again after the closing process to get a listing of all the accounts with their respective balances, just to make sure that everything looks okay. So, what's the focus of accounting here? Well, the focus of accounting is on three different things. So, what does the business own or control? Okay. So, what do they actually own? What do they actually have within their control? Then the next question is, what does the business owe to others? And so they can owe creditors, they can owe investors. Okay. They can also owe the government because they owe taxes. And then finally, how did the business perform during the financial period? So those are three very important questions that we want to be able to answer using financial accounting information. And so how we do that is we have a set of financial reports, individual statements that are going to give us information that are going to help us to answer those questions. The first of the statements is called the income statement. The income statement reports revenues and expenses and the net income of the business. That balance, whatever it is, net income or net loss, is going to carry over to the statement of owners or shareholders' equity. Sometimes there's a kind of a sub statement to that called the statement of retained earnings, and we'll go over that in a little more specifics in a few minutes. Well, once we have that statement prepared, we can take our retained earnings balance and we can plug it into our balance sheet and compute our balance sheet. Our balance sheet is going to tell us what it is that we own and control and what it is we owe to our creditors and what it is that we owe to our equity investors. And then finally, we do have a statement of cash flows because while net income is important to know, and it's important to understand that it's being calculated on an accrual basis and that it's independent of whether we have enough cash to run the business or not. Cash is the lifeblood of a business, and so it's important to keep track of where cash is coming from and where it is going, where it is being used. And so the statement of cash flows provides us with that information. So let's take a look at the income statement here in a little more detail. The way it flows is you have your net sales revenue at the top of the statement. And it's net sales revenue because what we do is we take the gross amount of our sales revenue, we take out any things like returns and discounts and so forth. And so we net those sales revenues. And then we look at it and we take out and we say, let's reduce it by the amount of the cost of the goods that we sold. So we're in business to sell something. So we are selling something. And so we then go ahead and reduce the net sales by the amount of the cost of those goods that we sold. And we call that result gross profit. Okay. Then from gross profit, we're going to take out all the other operating expenses of the business. I mean, think about it. There's a lot of other things outside the cost of goods sold that are required to run a business, such as, say, the human resources department, the accounting and finance area, facilities and maintenance, IT. There's all kinds of departments that operate out there, and that's part of our operating expenses. So once we take gross profit and reduce it by our operating expenses, we have our operating profit. Then from that, we've got other expenses and losses that do not have to do with the cost of goods sold and don't have to do with operations, but are still part of the business. And so we take out those expenses and losses and we add back some revenues and gains that have nothing to do with the sale of products or the general day-to-day running of the business. And again, at some point in some video, we'll talk about what some of those expenses and losses are and what those revenues and gains are. But know that they exist. And so then you're going to have net income before income taxes. Then you calculate what your income tax expense is going to be, and subtract that from the net income before income taxes, and you have your net income after income taxes. And that's the amount that's going to carry over into the statement of retained earnings or the statement of owners or shareholders' equity. And so we get to this, and this is just basically a reconciliation statement. And so we have a beginning balance, say, of retained earnings. So it's the start of the period, and we have a balance that carried over from the previous period. Then we're going to take the net income for the period or the net loss. So if it's net income, we're going to add it to the retained earnings balance. If it's a net loss, we're going to reduce the retained earnings balance. And then if we paid any dividends out, we're going to reduce the amount of retained earnings by any dividends that are paid out. And then that we can calculate what our ending balance in retained earnings is. I'm sorry about that. The weather, I tell you, it's crazy. So, at any rate, so it's a reconciliation statement that just takes us from one beginning balance to the ending balance, tells us how we got there. Then from there, we go on to the balance sheet, and the balance sheet is going to have basically two sections. This is a typical presentation side by side, but there's also a vertical presentation where assets are listed over liabilities and equity. So they can either be side by side like this, or it can be vertical assets on top of liabilities and equity. And so with assets, we have our current assets. These are the things that we're going to be using during the current fiscal period, fiscal year. So cash is in here, accounts receivable is in here, short-term investments is in here, inventory is in here. So that's all your current assets. Then you've got your fixed assets. Your fixed assets are your big assets, things that help you make whatever it is that you make to sell. It's your factories, your office buildings, all of the equipment, furnitures, fixtures, major systems. All of that gets capitalized, and we generally call them either fixed or capital assets. Sorry about that. I need to take a sip of water here. And then we have our financial assets, and these are non-current assets. And this is where we have excess cash, say, that we don't need for the current period, and so we're going to invest it and put it away. We can put it away in equity investments. We can put it away in other financial type investments. We can put it away in debt instruments like buying bonds. So those are our financial assets of a long-term nature. If you were to go and look at the financial statements for Apple and take a look at their balance sheet, you would see that they have quite a lot in the financial asset area. And then we've got intangible assets. Intangible assets are things that do not have a physical presence to them. We talked about fixed assets, and we have inventory under current assets. Those have a physical substance to them. Intangible assets don't. So, for instance, if we have purchased a patent from somebody for some technology, that would be an intangible asset. Do we have a trademark? Do we have a copyright? Those are examples of intangible assets, and those would be recorded as part of the assets section. Then, of course, we move over to liabilities and equity. And under liabilities, we've got our current liabilities, which is all of our payables. Everything that we owe to everybody that's within the current period, within a year. And so we have our accounts payable that we owe to our vendors. We might have salaries payable, wages payable, taxes payable, all kinds of different payables that are due in the current period. Then we have our long-term liabilities. And these could be long-term notes, so loans that we've taken out that are not due, or at least not all of it is due in the current period. It extends out beyond the current period. And then we could also issue our own bonds, and those bonds could be out there for quite some time. 10, 15, 20, 25 years. And so those become long-term liabilities. Then underneath that, we have the equity, which is the owner's claim on what we have left. So after we take our assets and remove those liabilities, what's left has ownership claim on it. And the equity is essentially a combination of two things. It's the contributed capital. That's the capital that the owners and shareholders put into the business, and they receive, say, stock or ownership shares back. And then the other is earned capital. And the earned capital is the retained earnings that come in from the previous statement, the statement of retained earnings. And we would plug that in here. Okay? And so that's the balance sheet. That answers the question of what we own and control and what we owe to others. Then we get finally to the last statement, the statement of cash flows. And again, this is another reconciliation statement, but we break it down into three sections. We break it down into an operating section, an investing section, and a financing section. In the operating section, we're going to deal with changes in cash that are related to the day-to-day operations of the business. With the investing activities section, we're going to be looking at changes in cash that are due to changes in our investing activities, particularly as it affects, say, those fixed assets and those investments of the current assets that we don't need in the current period and we want to lock them away and put them away. That would be part of our investing activity. And then we have cash associated with financing activities. Financing activities is how we raise cash for the business. So things that impact, say, selling bonds for raising capital for our business, getting capital from additional owners, or paying out capital to owners and stockholders and so forth. So that's generally your financing activities. So this tends to be the cash raising portion of the business that has nothing to do with operations. And so we see a beginning and ending balance in each one of these, and then we net those balances together and come up with an overall, we started with this much cash at the beginning of the period, and this is how much cash we ended up at the end of the period, and we now have an explanation of where that cash was used. Where did we receive cash from, and where was it used in the business? And that's an important thing to understand, because we want to track both the income generation potential of the firm, and we also want to look at the cash part of the business as well, because we need cash to make the business survive. It is possible under accrual accounting to generate positive net income and yet not be generating enough cash to run the business. That is very possible, and it has happened in the past. And if it happens long enough, the business will collapse. So finally, we get to note disclosures. Part of the financial statements, part of the annual report, is a set of notes that are attached to those financial statements. They are very important to read along with the financial statements, because what they will do is they will explain to you the accounting rules that were followed to put together the financial reports. They will provide additional detail about any of the line items in the financial reports, and they'll talk about things like contingencies, such as lawsuits and stuff that might be going on, and then subsequent events, any events that occurred outside of the fiscal year but prior to the conclusion of the audit and the issuance of the financial report itself. And so those are the kinds of things that will show up in the notes. So when you look at an annual report, you want to be able to look at both the financial statements themselves, and you want to be able to look at the notes that go with them, because they are integral to the financial statements. So that's just kind of a broad overview of where we're at in terms of financial accounting. Again, videos that will come up will kind of dive into a little more detail in terms of each of the financial statements, and then we'll take a deeper dive into the accounting cycle itself and take a look at some practical examples of how things get recorded. We'll talk a little bit about modern day accounting systems, because back in the day, and I'm talking about back in the early part of the 20th century, most accounting offices were just people who were doing all of this recording. That is not true anymore. We have computer systems that are taking care of most of it. And of course, with the advent of robotic process applications and now with artificial intelligence, we're beginning to realize more and more efficiencies where we are able to take these routine, mundane, repetitive types of activities in accounting, and we're able to automate those things so that they can be handled by the machines, the computers, and then people are responsible for basically monitoring these things, troubleshooting when something happens or goes wrong, making sure that the information that's coming out is reasonable, is correct. So we still have to understand what's going on inside the black box, so to speak. We can look at a computer system as a black box. Input comes in and output comes out. And so we need to know what goes on in the black box. And so accountants are responsible for that. And so we do have to keep track of it. So it's not really technology isn't really taking our jobs away. It's just changing the nature of those jobs. And so there'll be more jobs in the area of, say, analytics, to be an analyst. And so, which is going to be kind of maybe a merger of economics, finance, and accounting together with a lot of maybe systems as well. So at any rate, so we'll be talking more about that in the future. So thank you for joining me, and I hope you found this I hope you found this useful. Again, it's not meant to be a deep dive. It's meant to be kind of a very surfacey, 30,000 foot kind of view of what's going on. We will take some deeper dives into some of the specific areas. And again, this is being presented at what we would call the freshman, sophomore level in college, the principles of accounting. This is the accounting that everybody takes. All business majors take these principles of accounting classes. And so that's the level this is intended for, not for, say, the hardcore accounting classes, the ones like the intermediate accounting sequence or advanced accounting or so forth. So this is more high level. All right. Well, thank you very much, and look forward to presenting you with some additional videos in the near future.